All right, everybody, welcome to Weekly Roundup. I'm Scott, that's Ben, as you know. And it is July 22nd, 2022.
That's right.
Week went by fast, I think.
We
were
did,
busy.
yeah.
We were busy this week.
Yeah.
Yeah, it's good.
Yeah.
So what was the market up to this past week here? What grabbed our attention?
Lots of things going on, I guess, more in corporate world than central banks, because central banks have taken a lot of attention the last little while, but we had a little breather this week with some of the corporations reporting. We had Tesla report this week. So that's a lot of people like to listen and hear what's going on with them. And depending on how you slice it, they made money. But the market seemed to like what they said anyways, is they had a profitable quarter, but margins were down. They sold their Bitcoin position down by 75%, I think, more they'd originally bought it. That was, if you listen to the call, Musk said that it was in regards to the concern about liquidity in the market, as opposed to anything to do with Bitcoin, the liquidity that is of Tesla, not of Bitcoin. So he wanted to make sure they had plenty of cash and liquidity if the cash crunch that the world is seeing right now continues. So he sold that position down. You know, margins coming in is not a surprise considering the amount of other companies in the electric car company business that are starting to take market share from them. So the market liked the quarter. And then I'd say from a miss perspective, we had Snap report today, or they make most of their revenue from advertising, and so advertising dollars were down significantly, and they made no money this quarter. And the stock, I'm sure where we finished down here, so we finished down 39% today on Snap. So
wow.
So for the people that follow that kind of talk about these companies, they say, you know, reasonable precursor to think about advertising dollars. And so what is this going to mean for Google? Yes, Google would be obviously the behemoth in the room, but certainly when advertising dollars start to get a little bit tight, it even has an impact on their bottom line.
Yeah, I can imagine, for sure. I guess everybody would be in the same boat as far as that's concerned.
Yeah, all the companies that like Meta and the companies where the big revenue would come from advertising. Yes.
Interesting.
Yep.
Okay, what else do you have for us? What'd you get up to in the portfolios this week? Anything?
No. So continue to be more of happy to see how things are reacting, certainly from the bond market perspective, as we continue to see bonds rally this week, really across the curve. If we look out at the Canadian and US 10-year, now we're looking at kind of Canadian 10-year at 2.84% and US 10-year at 2.75. So, you know, we got up to kind of 3.5 in June, just before the June meetings in both Canada and the US. And I do think those were the high prints for yields. I don't think we go down in one direction here, but we've certainly seen bonds continue to rally, and that yield curve where the 2-year yield, which is kind of the end that central banks would control, and the 10-year yield are again inverted, are roughly 25 basis points right now, which is quite large from a historical perspective, and also has almost always been a precursor to a recession. So, you know, the bond market continues to tell us this is where we are. I think the depth of that is what we're trying to work through right now. So not a lot of changes in the portfolios this week, just really seeing, you know, bonds are picking up, US dollar has been strong. And so those are two positive things right now.
Okay, great.
Yeah.
Anything else before we get to the charts?
So no, more of looking at, we saw some kind of 52-week lows again on more companies this week, and I mentioned that last week, where, you know, I pull up and screen at the end of the week which companies have touched their 52-week lows, and they got pages and pages of it in both Canada and the US, where you look at how many companies are 52-week highs. You know, there's potentially 2 or 3. Most of those are kind of money market ETFs more than anything. So lots of these businesses continue to come down. Yields are getting to a nice point, and so spending a lot of time just looking at what and where we should be putting some money soon. But I'd say that's about it before we have a quick look here at charts.
Okay, great. All right, well, you pull those up. If anybody has any questions, the thing is too, the questions don't necessarily have to be about what we're talking about. Any topic will do. So you can just throw those in the chat or the Q&A. That's fine. Just saying that, I better pull that up myself to see if anybody has any. Okay.
Okay.
All right, whenever you're ready there, Ben.
Yeah, so I think 2020, at least so far this year, has been the year of volatility. And so we've talked about a lot of strategies that I've used in the past, looking at, some put protection, things like that into portfolios, bonds as well. Like these are things that have had a tend to reduce volatility dramatically. But this year it's been a slightly different case. And so wanted to just have a kind of quick 2 slides on that. So this is the bond volatility index, otherwise known as the MOVE index. So it gives you a sense that just, as we've had this year where stocks and bonds kind of have got moved in tandem, the one thing that stood out to me is that bond volatility has actually been quite elevated this year relative to what we've seen in the past. And so we're sitting here with bond volatility still quite high. But the positive sign is, as I've said this week, is bonds rallied, but volatility is falling. So it's an interesting thing to pay attention to and see if that trend continues, particularly with the central bank meeting in the U.S. next week.
Right.
Yeah.
Great.
Yeah. So the contrast to that is equity vol, and so lots of CNBC and BNN kind of talk about elevated volatility in equity markets, and this is a kind of a over the last 2 years, just to give you a sense. It's elevated, but we haven't seen anything yet where it would lead me to believe that this is over, like that the market's washed out and that everyone's done with kind of this bear market selling that we've been seeing. And so again, volatility is really kind of muted right now. And so this gives me kind of the sense that this rally we've seen in stocks is more of a bear market rally than the fact that the base is that the floor is in. So it's one of the things that I'd keep an eye on.
Great.
And then two more quick ones. Part of why I want to talk just briefly about natural gas is that there's so much attention going towards it, particularly with what's happening in Europe right now. And so Europe continues to be quite challenged with their electricity needs. And so you've seen coal consumption spike. But this is just a quick view of where the natural gas basins are right now. And so, this is obviously Russia here. And so Russia has an enormous amount that continues to be like the lighter areas are the ones that aren't quite explored yet. So Russia has a huge amount of this. And so, I think there'll be a lot of attention put towards where electricity is going to come from, continue to increase look at infrastructure and nuclear energy right now. But I thought this was an interesting chart to see where this comes from.
Very interesting. Great.
Last one, we'll leave it at this. Last one here. I mean, I've put this one up a few times in the past as well. But the reason I thought this was kind of interesting is, as we try to look at what's ahead in the world and in the technology world, what's interesting is, these are the different layers of what the technology Web3 looks like. So a lot of these companies now where they used to be all names you didn't recognize. A lot of the companies on here you'd recognize with, Meta, so Facebook, Google, Discord, like AWS, like these are the infrastructure providers. Like these are some of the biggest names in the US right now that fall onto the screen because you've seen them put a heavy amount of investment into what's coming with Web3 and things like that. So interesting to see how this slide has grown, even if we went back in 2 years ago and put up, but it used to look like it's changed dramatically.
Yeah, incredible. This is very interesting. And you're right, there's a lot of brands that you recognize, right? Especially in the top half of most of those lists.
Yeah.
You know, yeah, great.
Absolutely.
Great. Is that it? Or you got one more? That's it?
That's it.
Oh, wow. 4. Good for you. You must be anxious to get out in that nice weather. Keeping it short.
Yeah.
Okay. So what are we looking to for next week?
Yeah, so continued time and attention has been going towards what central banks have been doing. The one thing I didn't mention that happened this week was a European central bank, I almost forgot. They raised rates for the first time in 11 years. So they went from minus 0.5 to 0. So now instead of losing money, you don't lose money.
Wow.
And so it's flat.
That's a big move. It is really.
No, in all seriousness, we've gone from a point where we were 2 years ago, where there were negative interest rates in 70% of the sovereign debt market, to the only country now that still has negative rates is Japan. And so the ECB went from negative half to 0. And so next week we have the US Central Bank on the 27th having their meeting. So right now, you're looking at 100% likelihood that 75 basis point increase is happening. I would guess, based on what Canada has done with the 1% move, that FOMC probably does the same thing. And so lots of time next week will be assessed with what they're doing, why they're doing it, and then where we go from here. So that's what's ahead next week. Pretty big week.
Gotcha.
Yeah.
Okay. Anything else before we call it a weekend? Last call for any questions here.
No, I don't think so. As when I think about the cycles, and I've had good client conversations this week just about where we are from the start of the year to today. I said kind of start of the year, listen defensive, I think makes a lot of sense. We need to think about how this year is going to play out. And the further and the longer this kind of rolls on, where we're in choppy to down markets, we get closer to the point where valuations get attractive enough where you can start to say, okay, well, we look at a company like Sun Life and say, this is a great company, good business. It's down a lot here so far year to date. Maybe it makes sense to start considering adding into that. So spending a lot of time doing that. And so I'd expect we continue to do that. And I'd be looking at shifting towards now, maybe it makes sense to increase the risk tolerance, and we're getting closer and closer to that every day.
Gotcha. Okay, on that note, we'll call it there. Thanks everybody for joining, and we'll see you next week.
Sounds good. Thanks. Take care.
Have a great weekend.